Some people are asking about Best Buy, Paul. Do you want to do
That's a good one.
Let's do Best Buy.
Go ahead.
Guys, in our 8-pillar app, it's going to show you the 25, 50, 100, 200-day, and 300-day moving average. Right now, Best Buy is above on everything but the 25-day moving average. So in the short run, it's dropped. So short term, there's some negative momentum, but long term, there's definitely positive momentum. It is a $30 billion company with $45 billion in sales, a 16.9 PE check, profit margin 3.8% X. Now, this is a reason why I'm getting rid of profit margin in the 8 pillars. I don't care. I expect this from Best Buy. I don't care. They're about the volume. I'm fine with that. Now, they have a dividend. They have a dividend of 1.9%, which was $560 million last year. Their free cash flow last year was 4.84. So they're only paying out like 15%. Because one thing you got to remember, guys, everybody thinks that dividend is guaranteed. It is not guaranteed. You have to be able to understand. A lot of times companies will sucker people into a dividend by borrowing money to pay a dividend they can't afford just to get investors in to drive the stock price up, okay? This is easily sustainable. Their free cash flow last year was $5 billion. In the last 5 years, the average is $2.2 billion. They only paid $560 in dividends. They can easily afford by a 4-to-1 ratio the average over the last 5 years.
Now, you know I love you.
But
that was fast. I mean, that was a lot coming.
Oh, I'm really sorry.
So
guys,
because we're jumping. I halted you on this as we're jumping to 7 and 8 before we get we got to ease into it.
I got you.
You got a massage.
I was talking about the dividends. So dividends, guys, are not guaranteed by a company. Okay, so I always want to look at the dividends and look at their free cash flow, and see is there good margin there. Last year, their free cash flow was $4.8 billion. They paid $560 million in dividends. Easily handled. I go back 5 years, their cash flow has been $2.2 billion a year for 5 years. Again, they can easily afford that with their dividend.
Okay.
So they're perfectly fine paying that dividend. I feel very comfortable with it. Now, one of the metrics I do want to put into the 8 pillars to remove profit margin is return on invested capital. The market's going to do about 10%. This basically says how much are you going to make, how much does the company make on its own money? They do it through debt, they do it through equity. How much return do they get on there? The market does about 10%. In the long run, a company will do about what its return on invested capital is, according to Charlie Munger. This is 13.9%. That is solid. And the great part is, this is based on a 5-year average. It's not based on 1 year. 1 year, I'm sure it's way higher. But I like this. A 5-year return on invested capital of 13.9%, that is solid. I will probably change my 5-year to about 12.5% due to the fact that it's an increasing number. I want it to be, net income is increasing, so it's going to be swayed by an average over the last 5 years. I won't get into the math of it, but a lower number is okay as long as profit's increasing, okay? So I like this number a ton. This is a huge number for me. Love it. Best Buy does a great job of making money on its own capital. That is awesome.
While Paul makes his screen just a smidge bigger, I just always entice you to tickle that thumbs up. As always, we need the support, and we love you guys. We appreciate it. Let's look at the revenue and profit of Best Buy over the past 5 years.
So look at the revenue here, guys. Back in 2011, they did $50 billion in revenue, and it fell to 40 the next year. Now it's been stagnant, but now it's starting to come back up. 47 billion versus 39. This is awesome. So in the world of Amazon, they've done a great job, a phenomenal job of increasing their revenue over the last 5 years against Amazon, guys.
Incredible.
That's amazing.
Geroy said, if Paul's going too fast to me, he said, just rewatch the video. The rest of us are doing fine. So, okay, go ahead, Paul. Keep going with the bid.
Thank you, Geroy. I would always say that with my father, the only disrespectful thing I'd ever say to him, Paul, slow down. Dad, listen faster.
That's true. Profit growth, Paul. What do you think?
1.23 to 1.8. Check mark there. In the world of Amazon, they are increasing their profit over the last even 10 years.
Now, how about them shares? Pillar number 5.
What do you think the shares are going to be, Seth?
Shares outstanding for Best Buy. We haven't looked at the price, so that usually is one of my determinants. Is it high or low?
I'm going to say it's decreased. Oh, it's definitely decreasing. 20% decrease. Look at this.
Wow.
313 million down to 259. That's awesome. So they're taking their cash flow and buying back shares, and that's a smart move to do on an undervalued company that is going to try to give return to investors with free cash flow. This is a phenomenal thing to do.
The chat is lighting up because we have only 1x at the profit margin, which is expected for this retail.
That's why I want to get rid of profit margin.
Current assets over current liabilities is pillar number 6.
14.5 billion versus 12.95. Check mark there.
Uh-oh.
Check, please.
free cash flow. Now, we sort of spoiled the numbers before. Their average free cash flow is $2.2 billion.
Can you pump the brakes here, Seth? I tell you to slow down all the time.
You're right. Go ahead.
Guys, I make it very easy for you.
My apologies.
This is the free cash flow. I've added it to the investing portion of the cash flow statement. And then right next to it, I put that 5-year average. I want this to be as easy as possible for you. It is right here, ready for you. Yes, you can look. Now here's the deal. Here's what I will say. Look at the last 5 years. Seth, do you see something here?
Nice, consistent. Wait a minute. What is that last one, though?
2020, a lot of people were buying from home. So this is an astronomical jump in free cash flow.
Wow. So we can't. Okay. So
I want to basically throw this year out. Because I don't believe this is going to be the way it's going to be for a long. Maybe it is. Maybe it's a blend. Maybe you discount this.
I agree, because Amazon exploded as well, Paul. I mean, everyone was buying from Amazon, so.
And maybe this is a good new way of doing it. But so many people would have thought, with all the stores shut down, Best Buy would have been killed. Look at their free cash flow. It freaking tripled. Quadrupled.
They did an awesome job with curbside sales.
Yeah.
They weren't allowing people in stores, but their curbside was just boom. It was great.
How often do you return something, Mo or Paul, on Amazon? Like, if I buy it on Amazon, the return process I don't like. I'm just keeping it.
I don't return very often.
Right? But with Best Buy, man, their return is like, here, just take it back. I bought you something for this studio. I cut the whole plastic open. It was complete garbage. Took it right back. I mean, I like that. Return is, sometimes I won't buy from Amazon because the return process is so difficult. And I just love this.
That's awesome.
What are we at now? Free cash flow.
So the average is 2.2 billion, Seth. What's the market cap?
30 bill.
Divided by 2.2 is 14, give or take.
That's pillar number 8.
Check mark there. Because we want it below 20. And I think 14, man, look at where this company was selling just in the last just a year ago.
Yes.
You could have bought this company at 7 or 8 times free cash flow. And look at our 8 pillars. We have 1x.
Look at that. Would you look at that? You're liking Best Buy now all of a sudden.
I like Best Buy. I wrote a lot of puts on Best Buy back in the day. I wrote a lot of puts on Best Buy. I love Best Buy. I love this stock. But again, value. You have to sit there and look at the value and go, is it worth this? It's probably selling for what it's worth right now, is my guess. Probably selling for about what it's worth. The great news is, with everything money, we're going to give you a stock calculator that you can input all of your assumptions, and it'll tell you what you should pay for the stock today, or what it's worth to you today. You put in all the assumptions. I'm not going to tell you what the assumptions should be. You put all the assumptions. It'll tell you the historical numbers, so you can make a decision based on that. I like Best Buy. I would add this to I would put a tracker share on this.
No, you're putting a tracker share on?
I'm teasing. There's no tracker share.
I don't even know what that
but
means.
I would add this to your watch list, and I just love this company. I think it's great, and I just love the brand. I feel warm and fuzzy when I go inside Best Buy.
And it smells so good in there. It just smells like technology.
And they sell candy now at the
And
front.
they do sell
They've
candy.
been selling candy for the last 10 or 12 years.
You love grabbing that little.
I don't do it though.
Let's go to Mosif, the trading genius.
So I'm actually, I should have just erased this earlier, but I'm loving this right now. And if you are in the Bid and Ask Nation, please put this in the Discord chat. I want to talk about this when I get off of here. We are coming up through the sweet spot so nicely right now. We've had a couple of days green. If this thing breaks out tomorrow like that, there's a good chance that I'm going to be buying this. The bid and ask difference is a little bit high for me. It's bouncing around. I want that to be 1 or 2 cents. Right now it's at 6. So tomorrow, if I get a green candle like that, I think I might be buying this. So somebody please put that in the Discord chat right now.
So somebody asked, what's the difference between net income and free cash flow? Over long periods of time, your net income and free cash flow should be pretty similar. Net income is affected by tax laws, SEC laws, all these things that how you report certain things. Free cash flow can also be affected by how you report things and can be manipulated, but it's money in versus money out. For example, when a company acquires another company and they might have overpaid by $1 billion, they will write off $1 billion. That affects earnings. It doesn't affect free cash flow or cash flow overall. Cash is how you get paid back. The other thing is, people think about capital expenditures. Free cash flow factors in capital expenditures when earnings factor in depreciation. And a lot of people add depreciation back in. You should not, unless it's a real estate company that has that depreciation. The capital expenditures are important. So I always look at free cash flow, which is another reason why I'm probably getting rid of the PE and the profit margin for the pillars. It's because I want free cash flow to be our focus.
Thanks so much for watching the video. We hope you were intrigued. If this style of investing speaks to you, click the link below to join our Patreon. As a patron, you get access to a wonderful community of like-minded investors where you can chat, connect, ask questions, and share ideas with badasses like you all over the world. The best part is you get the amazing Everything Money software. This is revolutionary, unlike any YouTube page. You can track your investments, look at stocks, and quickly run our 8-pillar analysis on any company you like. The top tier patrons get direct access to Paul and Trader Mo. You'll see their daily trades, their updated portfolios, and every options contract they write on a daily basis. We provide Patreon exclusive videos just for you, including live streams and exclusive content from our team. Our bottom patron tiers fill fast, so join today. But hey, if you don't believe me, look at all of our patrons' amazing success stories. In comparison to other financial platforms, our software is by far the best value. This is your chance to get serious about investing. If you're finally ready to level up your investing game, join our Patreon and let's start kicking ass together.